One of the more serious episodes that took place back in 2008, in addition to obviously the collapse of Lehman Brothers, was the U.S. government rescue of AIG, the huge New York-based insurer. It was decided basically by the authorities, the Fed, the Treasury and so on, that in a way in which they made the decision that Lehman Brothers was not too big to fail, they decided that they had no choice effectively but to rescue AIG. So let us have a look at the actual episode in the video that follows. Let us begin then by looking at the front page of the Financial Times on Wednesday, September 17th, 2008. And as can be seen, Fed in $85 billion rescue for AIG. Now, it's important to remember the date here. On the Sunday night in New York, that would have been the 14th, late on the 14th, going into the 15th, Lehman Brothers declared bankruptcy. The world's markets found out about this, of course, on the Monday, the 15th. By the Tuesday, the 16th of September, the U.S. Federal Reserve was asked in no uncertain terms by AIG that if it did not provide support, some kind of rescue for the insurance company, then the crisis, which was beginning to unfold, could actually go through a major additional downturn. Just a quick overview of what did actually happen. AIG, through its subsidiary, AIG Financial Products, built up huge indirect exposures to real estate-backed debt. It turned out to be one of the main providers of over-the-counter credit protection through credit default swaps, which we're going to come on and talk about in a moment, on structured finance products, including mortgage-backed securities and CDOs, collateralized debt obligations, many of which were backed by subprime mortgages. Because AIG enjoyed a superior credit rating, at one point AAA, and even in the lead up to the crisis it was AA, the derivative counterparties that AIG was dealing with in the CDS or credit default swap market did not typically require AIG to post collateral at the time new contracts were being written. This has now been completely superseded by the clearinghouse world, which does require mark-to-market collateralization on a daily basis of exposures, say, in the CDS market. But at the time, AIG agreed to post collateral on its exposures to the counterparties only if contracts fell in market value significantly, or if AIG was downgraded in terms of its credit rating, which of course eventually did happen. Now, the performance of AIG during the period over here on the screen can be seen. This is 2006 through 9, and we can see here that during, say, 06, 07, very substantial revenues, more than $100 billion, with earnings, positive earnings, of course. But by 2008, the revenues had dropped down to just over $11 billion, and we were now seeing massive losses, massive negative earnings for the company, almost $100 billion here in 2008. These would have been mark-to-market losses at the time on its CDS exposures of close to $30 billion. So obviously the situation in 08 deteriorated dramatically, and that of course is why we saw the request to the US authorities, the Federal Reserve and so on, for a massive bailout of AIG. Just quickly to remind us of what a credit default swap contract looks like, here we have, say, a protection buyer. This could be any number of institutions. It could be a bank, an insurance company, pension fund, and so on. That company then has exposure down here to what might more typically be a bond, but for example, in the period leading up to the '08 crisis, very often this would actually be a mortgage-backed security, a CDO effectively, many of which were ultimately based on subprime mortgages. Now, the protection buyer is concerned that there might be a default down here, goes into the CDS market, identifies a party over here, and now for our purposes, let's just consider that to be AIG, because AIG was extremely active in this regard. And a premium then is paid by the buyer, the insurance premium effectively, to the seller, in this case AIG. And then if in this case, say the subprime MBS down here defaulted, then AIG would be on the hook and have to make a substantial payment. This payment would need to be made if and only if there was a default. But in the world of mark-to-market, a deterioration in the creditworthiness down here could and should result in the seller, AIG in this case, posting collateral. As we saw from the previous slide, back in the period around leading up to the crisis, this kind of margin requirement was very informal, nothing like the way in which the collateralization of exposures is handled today by central counterparties. As I mentioned a moment ago, AIG's credit rating during this period here started out before, say, March of 2005, with all three rating agencies providing a AAA rating to AIG, quite exceptional, very unusual. As you can see, over the next 3 years, this credit rating deteriorated substantially, and as we moved further into the crisis period, Fitch, for example, downgraded the rating to AA-, and then eventually A. Moody's and S&P had already led the way down with a ratings downgrade here to A- by S&P. I might just mention here, make a recommendation of a book which I have found very, very illuminating and useful in terms of understanding many of the things that went wrong back in the '08 crisis. One can see here, this book is entitled Stress Test. It was written by Tim Geithner. This is the gentleman here. Now, he was very well positioned, uniquely well positioned, really, to write this book about what happened in '08. He was, in fact, the president of the Federal Reserve Bank in New York in the period leading up to '08, and then after Obama became president in '09, he then was asked to and took up the role of Treasury Secretary, which he served for the first 4 years of the Obama presidency. And in this book, he goes into very interesting detail about what happened with regard to the collapse of Lehman, and also in much detail regarding the demise, the meltdown really, that took place at AIG. So I would highly recommend this book to you. Let's have a quick look at a timeline of the massive miscalculation of risk on the part of AIG. We can start with this one in August of '07. So at the end of '07, 65% of AIG financial product securities was invested in MBS, asset-backed securities, and CDOs, the subprime CDOs that I have mentioned even. This is the source on, you can see the source on this. During a conference call with investors, high-ranking AIG officials stressed near absolute security of the credit default swaps, that it had taken the protection seller perspective. The transcript of this call shows that AIG's chief risk officer said the risk actually undertaken is very modest and remote. And then this gentleman here, Joe Cassano, who oversaw the division, AIG Financial Products, which, by the way, was based in London, not in New York, said on the call, "It is hard for us, with and without being flippant, to even see a scenario within any kind of realm of reason that would see us losing $1 in any of those transactions." That surely must go down as one of the most classic understatements or miscalculations of risk in the financial world in a very, very long time. And you can see here the CEO, also shown by the transcript on this call, said, "That's why I'm sleeping a little bit easier at night." Eventually, I suspect his sleeping habits became very much more problematic and troubling for him as things unfolded. Now, in November of 2007, the SEC filing that AIG was required to submit showed $350 million in unrealized losses from its CDS portfolio, but they said at the time that it would be highly unlikely that AIG would really lose any money on these deals. By the very end of December, AIG now disclosed $1.15 billion in further unrealized losses, bringing this to a total of $1.5 billion for 2007. But again, to downplay the risk, minimize the problem, during a conference call, the CEO says that the probability that AIG would have to pay out under this is close to zero. And he pointed out that AIG's risk modeling system has proven to be so reliable, and since the transactions were so conservatively structured, AIG had a very high level of comfort with its risk. And as we move now into 2008, in its year-end regulatory filing, AIG now said that it set aside $11.5 billion for unrealized losses on its CDS exposures. AIG then disclosed that it had posted $5.3 billion in collateral with the counterparties where it had negative exposure. This was the first time the company disclosed the amount of collateral that it now was being required to post, given, for example, the deterioration in the credit rating, which we've already seen. AIG put the notional value of the CDS portfolio at more than $500 billion. 61 billion of the swaps were directly exposed to subprime mortgages. The company also announced that Joe Cassano, the chief of the financial products division that I mentioned, had resigned. It did not disclose that he was kept on under a $1 million per month consulting contract. As we get very close to the unraveling of Lehman Brothers and the beginnings of the full-blown 2008 crisis, in August of 2008, in its second quarter filing, AIG increased its unrealized losses to $14 billion. And on September the 17th, 2008, as I already indicated from the FT article, the Federal Reserve Board came to the rescue of AIG by pledging $85 billion in a recapitalization of the company. And as a result of that, the U.S. government authorities gained essentially an 80% equity interest in the company. But that was just the beginning, the first tranche. By October the 8th of 2008, the Fed was then required to pledge another $38 billion to the company. On the screen now we can see the collateral calls to AIG that resulted partly as a result of the deterioration in their credit rating that we've seen, and also, of course, as the underlying mortgage-backed securities were starting to default. So, for example, here we can see this is money owed or a collateral call coming from Goldman Sachs. And here, for example, as we now move literally into the beginnings of the crisis, and this is just after the collapse of Lehman Brothers, or this is the day when the market really were informed that Lehman had collapsed. And you can see those three calls alone amounted to getting on for $30 billion. We can see substantial collateral calls coming from the French bank Société Générale. And you can see here in the critical period starting 12th of September, then after the Lehman collapse the next day and so on, there you can see essentially the best part of $80+ billion, which of course was the amount that the company went to request a bailout essentially by the US authorities. Now, there's a lot more to this story, but one thing I should say is that the there was tremendous animosity, very bad feeling in the United States at the time about what had gone wrong with AIG, as indeed what had gone wrong with Lehman and so on. And initially, there were demands coming, especially, say, from politicians and other sources, as to a full disclosure on what had happened to the 85 billion, which eventually amounted to about 180 billion in rescues by the US authorities. What had happened to the money? And as you can see here, Bloomberg reported, in fact, Michael Bloomberg himself was one of the people that was pushing very strongly for disclosures. The New York Fed pressed AIG to withhold details from the public about the payments that they would be making to their CDS counterparties. And as can be seen here, substantial amounts were paid out to Soc Gen, Goldman, Merrill Lynch, Deutsche, UBS, but they did not provide a full disclosure of all the monies. The total here, this was what was disclosed, was only $62 billion, but as we have seen, there were far more substantial amounts that were demanded or that were needed to be posted as collateral, or even in the case of actual losses by AIG in terms of its CDS exposures. So a congressional watchdog that was appointed after all of this had occurred, the post-mortem essentially, this congressional watchdog criticized nearly every move the Fed made during the AIG fiasco. Much criticism was made of the fact that the Fed did not try to negotiate reduced settlements, but paid out 100 cents on the dollar. Many people took the view, well, if the Fed hadn't rescued those counterparties, like, say, Goldman Sachs, Soc Gen, and so on, would have got virtually nothing. And the argument was that why couldn't the actual amounts paid to, say, Goldman and Soc Gen and so on be, say, 75 cents on the dollar or 80 cents on the dollar? There's a lot of intrigue about that, and I would go back and recommend that book I mentioned by Tim Geithner. No charges were ever filed against AIG or any of its executives. In fact, there's another scandal that occurred at the time because AIG was paying out rather lavish bonuses to its top executives, despite the fact that it was being propped up essentially by the US authorities. In all, the government rescue package totaled $185 billion or thereabouts. And one of the more ironic aspects of this whole debacle was that the former CEO and large shareholder of AIG launched a lawsuit against the US authorities, saying that they went too far by demanding exactive terms when they rescued the company in 2008. Really quite an extraordinary development. The case went to trial, but there was no damages awarded by the courts, despite this lawsuit levied by the former CEO. And the final slide essentially is what you might consider perhaps a happy ending. So the government was repaid in full and even received a bonus. So you can see here that at one point the rescue amount had reached 182 billion, or certainly in that vicinity. And once the company had repaid the government no longer had any stake in the company. And in fact, as you can see here, this comment by the president and CEO of AIG, he made the point, "We appreciate the opportunities this support from the government allowed and are proud to have returned to America every cent plus a profit of $22 billion. This actually came in the form of warrants that were issued when the rescue package was being negotiated, and those warrants were eventually redeemed with a $22 billion profit for the US authorities. So I very much hope that you enjoyed that video, and I just want to tell you more about my YouTube channel, the Corcoran Codex. As can be seen, the focus for this channel is to analyze critical ideas and episodes in the world of finance, such as what we've just seen with the rescue of AIG, could I maybe urge you to subscribe to this channel, because I am adding new content along similar lines all the time. And I'd like very much to thank you for watching this video.